All right, buckle up, y'all. This is going to be a long one. So, accounting methods, number one, definitely appears on the CPA exam. There's just no question about that. But more importantly, what I find is that I teach this at firm training for both first years and second years. So that means, brand new staff training and also at the end of the first year training. We do a little bit less of this by the end of the second year. So kind of what you would call third year training. But that's because there's no way to escape this. We absolutely, if you're going to be a tax advisor, you have to know the methods of accounting for tax purposes. So I apologize for the length of this one. I know it's going to go on way too long. We're going to have lots of questions though. So meaning, I'll pose lots of questions to you to answer. So hopefully that gives a little bit of break from just listening. Okay, this is a notoriously difficult area of tax law, and it's just because it doesn't get paid attention to all that much, to be honest. So what I've done is I've kind of broken down what we're going to look at, right? So you're either a cash basis or an accrual basis taxpayer. And if you're cash basis, you recognize income under the constructive receipt rules, and you recognize deductions when they're paid. And we're going to see that we're going to back way off on that assumption, but that is kind of the general rule. For an accrual-based taxpayer, you recognize income when you meet the all events test, and you recognize deductions when you meet the all events test, plus you have economic performance. But there are exceptions to all of these. There are literally exceptions to all of these. That's what makes it so crazy and probably so difficult. Okay, well, let's start with cash basis. And we're going to do income first, and then we'll do deductions after that. So for a cash basis taxpayer, income is recognized in the taxable year during which is credited to his account, set apart for him, or otherwise made available. And again, that's their language, of course. These days, we wouldn't write that was set apart for him or credited to his account. That would be a there, but I'm just reading directly from the regs. So we're stuck with kind of this bad gender language. Anyway, so that he may draw upon it at any time, or could have drawn upon it if notice of intention to withdraw had been given. However, income is not constructively received if the taxpayer's control of its receipt is subject to substantial limitations or restrictions. Okay, so this is the constructive receipt rule. And there's no better way to go through this than, frankly, to do some examples. So, Colbert is a cash basis calendar year and taxpayer. Determine whether current year or next year for each of these items. So, basically, when does constructive receipt occur? So, Colbert gets a check from a customer on Friday, December 31st at 11 a.m., sticks it in a drawer and says, oh, I'll deposit it next year. Is that constructive receipt in the current year? Absolutely, right? So, for sure, the funds have been made available to Colbert. He could certainly go negotiate that check he received, or go deposit in his bank, whichever one. Number two, Colbert gets a check from a customer Friday, December 31st at 3 p.m., but he's already made his daily deposit and says, I'm going to stick it in a safe and deposit it next year. Constructive receipt has still occurred, right? He still has control. He still has power over what to do with that check. Number three, Colbert gets a check from a customer Friday, December 30th, 5:30, after the bank is closed, sticks it in a safe to deposit next year. That is still constructive receipt. The reality is, look, he could turn around and endorse that over to someone else and say, oh, here's this check, and now you can have it. And by doing so, he's using that negotiable instrument, right? I mean, that check is a negotiable instrument. He received it on the 31st. It's constructive receipt. All right, Colbert gets a check from a customer same day, 5:30, during his New Year's Eve party. He doesn't want to leave the party, so he puts the check in a safe to deposit next year. Well, clearly he's turning his back on that income, which you cannot do under the constructive receipt rules. So as a result, constructive receipt, that is income in the current year. Colbert gets a check from a customer Friday, December 31st at 11 p.m. during his New Year party. He is legally drunk and loses the check. He discovers the missing check weeks later and ultimately gets it replaced by the customer. That is still constructive receipt in the current year, right? Again, he cannot turn his back on it. Now, him being legally drunk might place a restriction on it. You just got to ask yourself, it's a substantial restriction, and that would probably be on a facts and circumstances based case, right? If he could keep the check, or he's not passed out, right? He's just over the legal limit, then chances are that's constructive receipt. If, on the other hand, he is completely unconscious, and there's no one who can be an agent for him at the party, which is unlikely, then there might be an argument there's a substantial limitation. But again, probably not. All right, Colbert gets a check from a customer on that same day. The check is post-dated to January 3rd of next year. Well, this requires digging in, and different textbooks say different things, but I have pursued this one down the rabbit hole, and the reality is that is still constructively received. Because what the situation is, if he took that check with a bunch of other checks and put his deposit into the bank, and the bank runs the checks, they don't look at the date on the check. Now, if he took it to a teller and deposited it, there's some chance the teller might look at it. But since most businesses don't actually do it that way, that check is going to get negotiated. And the reality is the rules for the bank say we can negotiate a check that's been presented in good faith, no matter what the date is on that check. So that is constructive receipt, and it is income to him in the current year. All right, Colbert gets a check from a customer on the last day of the year. The customer asks Colbert not to deposit the check until January 3rd, when he will have enough money to cover. Okay, we finally achieved substantial limitation. So what is the value of a negotiable instrument that has no value? Because if Colbert was to present that check, it would simply be rejected. So as a result, it has no value, and therefore it is not constructive receipt. And it wouldn't be until, in theory, next year he tries to deposit it, and hopefully there was enough money to cover. Okay. Little bit of constructive receipt at work. How about accrual-based taxpayers? How is that going to work for an accrual-based taxpayer? Well, they have to pass, as I mentioned previously, the all events test. And the all events test is a two-pronged test in which all the events have occurred which fix the right to receive such income, and the amount can be determined with reasonable accuracy. So we needed to figure out what it meant for all the events to have occurred to fix the right to receive income, because that sounds a little bit like earning the income. But it turns out the U.S. Supreme Court, in a case called Schlude, said, no, that's not what that means. In fact, what it means is you fix the right to receive income at the earliest of the following 3 dates. Number one, the income is earned. Okay, so that's never later than you would recognize it for book purposes. And this does, in fact, cover most transactions, because typically we think about earning the income, and that's when it's income. Yeah, that kind of is consistent with kind of our green visor accounting. But the other two things that could happen is the payment is due or the payment is received. Okay, so that screws everything up, because that means if someone pays you in advance for anything, under the all events test, you fix the right to receive that income, and therefore you would recognize it. Well, that creates a matching problem. So let's say you go out and you buy your friend a Cheesecake Factory gift card, and you give it to your friend in the holidays for 2023. So you gave it to him for Christmas or Hanukkah or whatever the holiday of choice is in December. And your friend goes to the cheesecake, they hold on to it, and then they ultimately go to the Cheesecake Factory in 2025 where they redeem that gift card. So on the left, you can see the book accounting for this transaction. We debit cash and we credit unearned revenue, right? That is exactly what that is. That's a liability account that says, hey, I owe someone this revenue at some point when they present that gift card, but not until then, so I have a liability. In 2024, nothing happens because nothing's presented. Then in 2025, when the gift card is presented, and presumably they spend all of it, now we would debit the unearned revenue and credit revenue. That's just basic unearned revenue accounting. There's nothing magical about that. When you receive a prepayment for deferred revenue or unearned revenue, this is exactly the GAAP accounting that you would follow. But let's look at what this would be under the all events test for tax accounting. So you would debit cash, just like you would, of course. Cash is cash, can't change that. But under the all events test, remember, it's the earlier of, and you've now received the money. So you just credit revenue. Well, this is absolutely horrific matching, because you're you're crediting revenue, so you're creating that revenue, but there's no cost of goods sold associated with it. So this is where this creates a matching problem. And so for years, the IRS has coped with this with something called Rev Proc 2004-34, and there were some regs under 451. But finally, in 2017, they codified it into 451C. And 451C says, okay, we're going to allow you to have an unearned portion of prepayments that you may defer no later than the succeeding taxable year, regardless of the actual period covered by the prepayment. That means there's a maximum of a 1-year deferral. You can never defer later than you do for financial statement purposes. So what is eligible for this deferral under 451C? Well, any advance payments for services, goods, sale, lease, or license of computer software, use of intellectual property, and a few other items. What is not eligible for this? What is not eligible for this deferral is rent, insurance premiums, and these are the ones, of course, that are income. So that's an insurance company. We don't deal with that very much. And then prepayments with respect to financial instruments, which would really be things like interest and dividends. Okay. So now we go back through and say, you know what, we're going to do the deferral system and hopefully get a better answer than we did under the all events test. So book accounting is the same. Now let's look at the tax accounting under 451C. Well, sure enough, we debit cash and we get to credit unearned revenue, just like we did for book purposes. However, remember, I can only defer up through the end of the subsequent year. So that means by the end of 2024, whether that gift card has been presented or not, I need to debit unearned revenue and go ahead and recognize the income for tax purposes. Again, not for book purposes, but for tax purposes. So what exceptions exist from the all events test? Well, prepaid interest, you generally recognize when received, but that has complex rules. We'll sort those out next week. And prepaid rent, also generally recognized when received, kind of same as the cash method. So what I want to do is there are some special rules about rental income and deductions that are definitely beyond the scope of the CPA exam. They're also beyond the scope of this course. Just want to make you aware that they exist. There's a code section out there that covers rent lease arrangements where there's giant increases late in the payment or early big deductions early in the payment. So, you know, they had to cope with a way because the second taxpayers felt like they could manipulate rent expense to get the deduction in the period they wanted, then the IRS had to come up with something. So, but again, beyond the scope of this course. Okay, so on November 1st, 23, Arnold receives 4,800 advance payments for a one-year contract to provide up to 48 dance lessons. So basically $100 a dance lesson. Arnold provides 8 lessons in 2023 and then 40 lessons in 2024. So let's look at this book accounting, because again, we got to understand the book accounting to understand the tax accounting. Well, not necessarily, but we kind of do. So when Arnold receives the money, debit cash, credit unearned revenue. Then at year end, since he's provided 8 lessons, he's going to go ahead and debit the unearned revenue for the 800, right? 8 lessons times 800 a lesson, and credit revenue for $800. So he's recognized $800 worth of revenue. Then in 2024, he recognizes the remaining 40 lessons. So he's just going to debit out, no more unearned revenue and credit all the revenue. So the $4,800 is earned over the 2 years. How about the tax accounting? I wanted the tax accounting to appear. When it doesn't appear, what happened? Let me see if I can fix that. Okay, rectified my tax stuff. Okay, let's look at the tax accounting. So we shouldn't have to look, right? Let's pretend like we know what we're talking about. So I'm going to debit cash, credit unearned revenue, right? Because under the tax rules, I'm allowed under 451C to make that deferral. But I'm required to recognize income when I recognize it for financial statement purposes. So in 2023, I'm also going to need to recognize that $800. Okay, then in 2024, I know that I cannot defer the recognition any longer. So it doesn't even matter to me how many lessons were given or how much was recognized for book purposes. I have to recognize all of it for tax purposes. So the remaining amount will be recognized for tax purposes, and that's equivalent to what we did for book. Okay, let's change the rules a little bit. It's $4,800 now for 2 years to provide 96 dance lessons. And so now we're going to give 8 lessons in 2003. We're going to give 48 in 2004 and 40 in 2025. Okay, let's think about what the tax accounting is going to look like before we even take a peek. So 2023, I get to set up the unearned revenue just like I do for book purposes. I'm going to be required to recognize that $400 worth of revenue. Remember, that's going to be 8 lessons now times only $50 a lesson because there's 96 dance lessons. So 400 I'm going to have to recognize for tax purposes. But then when it comes to year 2, I know I'm going to have to recognize 2,400, but I'm actually going to have to recognize all of the remaining deferral for tax purposes. So that means all of it would be recognized, all 4,400 that's remaining for tax purposes, leaving nothing left for 2025. All right, that is some good stuff. Let's do a few questions. Kant is a cash-based individual, owns and operates an office building, received the following payments during the year. So he received $30,000 in current rent during the year. He received $10,000 of rents that are applicable to next year. He has $5,000 of security deposits that are held in a segregated account and $15,000 of lease cancellation payments. What amount would be included in gross income? Okay, so as a cash basis taxpayer, there's no question that the $30,000 worth of cash you receive for current rents is includable. How about the advance rents? Absolutely, right? As a cash basis taxpayer, it is about constructive receipt. It's got nothing to do with whether he's earned that rent. So security deposits are not considered revenue, right? So there are certain rules in which the taxpayer can use the security deposit to offset the last month's rent under contract. Well, then it's just a prepayment of rent. And so you'd say that is, but typically a security deposit that's returned to the rentor, assuming they, turn the property back over in reasonable repair, then those are not included in income. Lease cancellation payments we didn't really cover. This was a CPA exam question. I figured, even though we haven't covered lease cancellation payments, we'll talk about them now. So a lease cancellation payment is basically when you pay someone who's renting your property, like, look, I need you to move out. For some reason, maybe I want to sell the property. There could be 1,000 reasons. Maybe I want to rent it to someone else for more. And what I'm going to do is give you incentive by paying you to get you out of the lease. So lease cancellation payment that's outbound. This is talking about an inbound. So this is when the rentor is in the same situation. They're like, look, I want to break my lease and get out of it. How about if I pay you 15 grand and we walk away from each other? Absolutely. But that is also constructive receipt and would be included in gross income. So that tells me that the 30, the 10, and the 15 are all included in gross income, making the answer to this question C. Now, what if Kant were an accrual basis taxpayer? An accrual basis taxpayer. Well, remember, we've got that great all events test. And the all events test would say, it's going to be received the earlier of, and all of these have been received. And so we would have a problem there. Then it's a question of, can we apply that 451C? But recall that rental payments are not permitted to be used under 451C. So basically the answer would be the same. The 30, the 10, and the 15 are all income to an accrual basis taxpayer as well. All right. Pablo's a landlord, deciding how to structure his leases. Assume rent is $1,000 per month in all cases. Here are his options. So the first month is upfront and a security deposit of 1 month that is returned if no damage. Got it? Or first and last upfront and half a month security deposit. And then lastly, first upfront and a non-refundable security deposit of $500, but then the last month's rent is only $500. What are the gross income consequences of each of these? And the reality is we no longer need to necessarily concern ourselves whether this is a cash or accrual basis taxpayer, do we? Because what we realize is that constructive receipt and actual receipt under the all events test are the same. And since we can't defer rental income, basically an accrual based taxpayer is more or less on standard with a cash basis taxpayer. Okay, so let's go with Pablo here. First month up front. Okay, so whatever he receives up front is absolutely going to be gross income. The security deposit that would be returned when there's no damage is in fact a deposit and is not income, certainly when received. Okay, so B, first and last upfront, half a month security deposit. Well, if I'm taking first and last upfront, doesn't matter how long that lease is, both of them, or 1,000 and 1,000, 2,000, would certainly be gross income. The half a month security deposit of 500 would still be a deposit. It's just he's taking a lower amount as a deposit. In C, the first upfront and a non-refundable security deposit, that's 500, but last month's rent is cut to 500. Well, that's not really a security deposit, is it? Right? What we're really doing is collecting prepaid rent, and we're calling it a non-refundable security deposit. To the extent it's non-refundable, that's just income under something known as the claim of right doctrine. So what the consequences of that would be: the first upfront absolutely is collected. The non-refundable security deposit is also gross income, so 1,500. And then the last month's rent, when received later on, would be gross income, but that's at a future date. Okay. All right, let's flip over to the deduction side. So let's start with cash basis. So as I mentioned at the top of this video, generally a cash basis taxpayer deducts an expense when it's paid. But let's think about if Helena pays $400,000 for a building. Does Helena deduct $400,000 for the cost of a building? Well, that honestly, we know that doesn't make sense, right? You got to capitalize that cost. So technically, you've created a benefit that's expected to last beyond the end of the tax year. And so kind of by default, you're supposed to capitalize that cost. And then cost recovery on that building would be a function of depreciation, most likely. But in other cases, it could be something like amortization, depletion, or you could recover the cost when you sell it, like you do with inventory. So Helena pays $60 for a 6-month subscription to a business trade journal on December 1st, 2023. Technically, the $60 is a prepaid subscription that must be amortized over 6 months, right? So you'd say, all right, well, I've got debit prepaid, credit cash for $60, and then for each month that goes by, I'll expense off $10 in dues and subscriptions expense and until the $60 is gone. But Congress wanted to ease the burden for cash basis taxpayers. And so they developed something called the 12-month rule. So the 12-month rule for prepaid expenses says you may deduct if the benefit period is less than or equal to 12 months and that benefit period does not extend beyond the end of the next tax year. Now, the 12-month rule doesn't apply to interest, and it applies to both cash and accrual. But what we're going to find later on is that accrual must also meet, of course, the all events and economic performance. And we'll talk about that later. All right, so on December 1 of 2023, Beta Corp, which is a cash basis corporation, pays a $12,000 property insurance premium with a 12-month term that starts on 12/15/2023. So normally we'd say, okay, kind of under the typical rule where the benefit period extends beyond the end of the tax year, which this one clearly does, right? The bulk of the benefit period is after the end of 2023. We'd say, oh, well, I guess I got to prepay that and then amortize it over the life of the contract. However, let's try to apply the 12-month rule. So does it extend beyond the earlier of 12 months after the first date on which the taxpayer realizes the right or benefit? Well, no, right? It starts on 12/15, it ends 12 months later. So it's exactly 12 months. Does it end after the end of the taxable year following the taxable year in which the payment's made? Well, no, it's going to end 12/15/2024. So it ends before the end of the next taxable year. So as a result, now let's make sure we understand that, right? This is the rule that sometimes trips people up. So when does he make the payment? When does Beta Corp make the payment? 2023. What is the taxable year following that taxable year? Well, that's 2024. Does the benefit period end before that subsequent taxable year ends? Yes, it does, because it ends on December 15th of 2024. So as a result, this meets the 12-month rule. So the entire $12,000 will be deducted when the payment is made. Okay, so let's say that instead, Beta Corp is like, hey, I like this plan. So I see where I can deduct all these costs up front. So on December 1st of 2023, I'm going to pay another $12,000 insurance premium, but this one's for a 12-month term that starts on 2/15/2024. So does it extend beyond the earlier of 12 months after the first date on which the taxpayer realizes the right or benefit? Well, no, again, it's a 12-month policy. So for sure, it meets that definition because it's exactly 12 months. But does it end after the taxable year following the taxable year in which the payment is made? Okay, let's make sure we track this carefully. So the payment is made in 2023. The benefit period starts on February 15th of 2024, and since it's 12 months, it goes to February 15th of 2025, which means that it does extend beyond the end of the subsequent tax year. As a result, you must capitalize and prepay and then amortize the entire $12,000. Okay, you're not allowed to deduct the amount that does fit within the 12 months. No. All of it has to be prepaid and amortized. How about for an accrual-based taxpayer? So for accrual-based taxpayers, you got to meet, and we mentioned this previously, the all events test plus an additional test called economic performance. So let's deal with what is the all events test with respect to a deduction. Well, this occurs when all the events that have occurred that establish the fact of the liability, and it can be determined with reasonable accuracy. So that sounds a lot like the previous one, right? Now, to that we add, and economic performance has occurred. So the term liability includes any item allowable as a deduction, cost, or expense for federal income tax purposes. So what is this economic performance? So what I'm going to say is it comes in three categories per 461H, section 461H. The first is when services and property are provided to the taxpayer. And this is, without question, the most common form of deduction, right? I'm buying services, I'm buying goods, they're being provided to me, I pay for them. When do I get to deduct the cost of those items? Well, when the services or property are provided. If it's for the use of property, which is different than taking ownership of the property, right? So think of taking ownership as I'm taking title to the goods, whereas using the property is more like I have the right to use the property, but I don't own it. That's like a rent or a lease. So in that case, economic performance occurs when the property is used. So it occurs ratably over the use of the property. So there's a rare occasion when services and property are provided by a taxpayer that gives rise to a deduction. It's not very common, but it does occur. And in this case, EP occurs as such property or services are provided. Pretty straightforward. And then the last category of economic performance is something called payment liabilities. And so the tax code made up this term, payment liabilities. And again, they're not very innovative. So what is a payment liability? Well, payment liability is a refund or rebate, awards, prizes, jackpots, provision to the taxpayer of insurance or warranty or a service contract. Taxes and licenses are payment liabilities. And under these circumstances, economic performance doesn't occur until the payment is made. That's why they're called payment liabilities. There's another tranche of payment liabilities as well. Liabilities under a workers' compact. Liabilities resulting from tort, breach of contract or violation of law, or any other item for which no specific rule is provided. But the rule is the same. Economic performance occurs when payment is made. Now, I've broken these into the two categories A and B. There is nothing in the code or the regs that break these down and call them payment liabilities A and payment liabilities B. That is purely a function of me labeling them as such, and we're going to see why in a second. Okay, I really like this handy chart. I will admit fully I stole this from KPMG, but it is a quick and easy chart that includes provision of property services, use of property, provision of property by the taxpayer, interest expense, which is always economic accrual. We know interest expense doesn't follow any of these rules, and then payment liabilities. So there are exceptions to the economic performance rules, and one of them is called the recurring items exception. And this exception applies where the all events test has been met, then economic performance will have been deemed to occur if Actual economic performance does occur within 8.5 months or the filing of the tax return. And I notice that's not written here, and it should be, right? So actual economic performance occurs within 8.5 months or by the filing of the tax return. Such item is recurring in nature and it is not material, and accrual results in better matching. Now, the reason I broke them out into A and B is the recurring item exception does not apply to payment liabilities B. So let's go back. So we can't apply the recurring item exception to liabilities under workers' comp, tort, breach, contract, violation of law, or any other item for which no specific rule is provided. And as we noted, it's also interest, right? Because interest is always on economic basis. Okay. 12/1/23 Alpha Corp, cash basis $12,000, rent for a 12-month term lease that starts 1/1/24. Okay, this is a cash basis taxpayer. We've got a benefit period that extends beyond the end of the tax year, but does it meet the 12-month rule? Yeah, it absolutely meets the 12-month rule, right? Just barely, but it meets it. It's a 12-month term, so the benefit period is only 12 months, and it doesn't extend beyond the end of the next taxable year. It actually ends on the end of the next taxable year. So this cash basis taxpayer can go ahead and deduct all $12,000 in 2023 when they make the payment. What if we change it to an accrual basis taxpayer? Okay, so the accrual basis taxpayer pays $12,000. All of this is the same, right? And it would meet the 12-month rule. It does, in fact, meet the 12-month rule, right? It's a 12-month period, ends before the end of the following tax year. But remember, you also have to meet economic performance. When does economic performance occur with respect to rent? Well, that's use of property, and it occurs ratably over time. And so as a result, this lease that starts 1/1/2024, you're going to prepay it and then amortize that prepaid over the 12 months in 2024. I want to contrast that with the same example, except now it's for an insurance premium. Okay, so all the same 12-month rules apply here. So really what we're distinguishing is, when does economic performance occur with respect to insurance? And the argument that taxpayers have made successfully is that, well, wait, if I'm buying insurance, that insurance applies as equally on the very first day of the year as it does on the last day of the year. Right? Because the risk of catastrophe is the same on the first day as it is on the last day. And so as a result, economic performance occurs more or less fully on the first day. So as a result, we can apply the 12-month rule, and we can go ahead, even as an accrual-based taxpayer, and deduct the entire $12,000 cost for these insurance premiums. Okay, I know that's quirky, isn't it? I told you accounting methods is tough. Okay, so let's do a quick reinforcement here. Gamma offers full refunds to customers that are not fully satisfied with its products. At 12/31/23, Gamma's trial balance includes the following accounts. So they have accrued refunds on their books of $25,000. So let's think about the tax accounting for that. So what that means is some of their customers have presented a claim for a refund. So they've submitted the paperwork and said, hey, we want our money back because this is an accrued refund. It's not a refund reserve account. Okay, so for book purposes, we go ahead and accrue that, don't we? Are we able to do that for tax purposes? Well, when does economic performance occur with respect to refunds? Well, if you've forgotten, let's go back a few slides, because why not, right? Refunds are a payment liability. Okay, now that I know they're a payment liability, when does economic performance occur? When they're paid. Well, if they were paid, would they have been accrued? By default, no. That's what an accrued is, right? I'm accruing expense prior to paying it. Otherwise, they'd be on a cash basis of accounting for book purposes, which is not permitted under GAAP. So in any event, I haven't made that payment. Shoot, that means I can't deduct these for tax purposes. Oh, but wait a second. Can I apply the recurring item exception? Okay, let's go ahead and make the election to apply the recurring item exception. Okay, well, that means I made refund payments of $15,000 May 1st, $10,000 August 1st, and I didn't file the tax return until September 15th. So under the recurring item exception, did actual economic performance occur before the earlier of 8.5 months or the filing of that tax return? Well, yeah, because I paid it on May and August 1st. That's before 8.5 months. As a result, I can deduct all of that $25,000 accrual in 2023. Okay, what would change if the tax return were instead filed on July 15? Well, if the tax return were filed on July 15, then that payment on August 1st is no longer eligible for the recurring item exception. And so as a result, for tax purposes, I would only be able to accrue and deduct $15,000 because that's the payment that was made prior to the earlier of 8.5 months or the filing of the tax return. So there are some special timing rules that I want to cover as well. The one that you see the most is based on compensation. So I can accrue compensation to my employees and I can deduct it if I pay them within 2.5 months. So just to be clear, 2.5 months is not February 15th, right? That's 1.5 months. 2.5 months is March 15th. Contributions to pension plans. You have until the extended due date of the return to make a payment and deduct a contribution to a pension plan. So the rules here are very, very forgiving, right? The Congress wants companies to make contributions to the pension plan. And it says, look, we're going to give you all the way until you file that tax return, including an extension to make that contribution. So amounts payable to cash method non-related parties must be made within 2.5 months. Charitable contributions generally are placed on a cash basis for accrual, but when we get to corporations, we'll see there actually is some room there. Amounts payable to cash method related parties are placed on a cash basis. And then, of course, contested liabilities don't meet the all events test, and as a result, there's generally no deduction for those. So who can use this magical cash basis method? Well, just about everyone except C corporations and partnerships with a C corporation as a partner. But there are exceptions. Farming can almost always use the cash basis. Qualified personal service corps can use the cash basis. And those that meet the gross receipts test, this started in 2018, where the average annual gross receipts for the 3-year taxable period ending with the taxable year, which precedes the taxable year, doesn't exceed what is now $29 million in 2023. It goes up to $30 million in 2024, and it is inflation adjusted every year. All right, we're getting close. We're not there yet, but we're getting close. So how about accounting for inventory? Well, accounting for inventory goes well beyond the scope of what we can cover in this class. We could literally spend no less than 3 weeks on this topic alone, because accounting for inventory is so complicated under 263 Cap A and all the other rules. So we're not going to do that, but we do need to understand some of the rules that apply to inventory, because we see that occasionally a question pops on the CPA exam about this. So a cash basis taxpayer that maintains inventory must use the accrual method with respect to the purchases and sales of that inventory. So technically, a cash basis taxpayer that maintains inventory is required to use accrual method for inventory. So what that means, you have beginning inventory, ending inventory, cost of goods sold. You do all those calculations that you do under the accrual method, even if you're a cash basis taxpayer. Now, that's not entirely true. Technically, a cash basis taxpayer has 4 options. One is they can account for it under the accrual method, no doubt. They can treat inventory as non-incidental materials and supplies. They can treat inventory the same as they do on their applicable financial statements if they have them, and if they don't, that they can conform to their business books and records. Okay, let's see what those 4 things are. So non-incidental materials and supplies, the rule says you deduct those in the year merchandise is sold, or not of, or paid for, whichever is later. Okay, so when I deduct that in the year the merchandise is sold or paid for, whichever is later, that's basically the same as inventory accounting. And so you gain nothing in terms of accelerating deductions of inventory costs by adopting the non-incidental materials and supplies, or the NIMS method. If you're using the same as your applicable financial statements, well, since financial statements are generally required to use GAAP accounting, they're going to follow accrual accounting, and so you're just back in inventory accounting. If you have no applicable financial statements, you can follow your books and records. So this means if on your books you expense inventory when it's purchased, then you could do that for tax also. But I want to make sure we understand the risks that you might run into. All right, so Dabinia operates a garage that repairs European-made autos. As part of the service, the garage purchases and then, of course, eventually sells a variety of car parts, including oil filters, brake pads, various belts and motors, such as alternators. So Dabinia expenses any part or supply as it is purchased in spite of the item not yet being sold. So, for example, Dabinia may purchase 5 oil filters when she only needs 1 for the current repair, but she knows, like, oh, I'm not just going to buy 1. If I buy 5, then I'll have some in stock. And so, with the expectation that the remaining 4 filters will be sold in the near future. So, Dabinia doesn't prepare applicable financial statements for her business, right? It's too small, so she doesn't have GAAP accounting. So, she'll be able to conform her tax accounting for inventory with her books and records. And as a result, she would be able to, in fact, deduct inventory when purchased. If, however, well, I shouldn't say that. However, the regulations around this indicate considerably less flexibility. So if, for example, as part of her regular business practice, Dabinia takes a physical count of oil filters at year end, right? So maybe at year end she says, oh, well, let me see how many oil filters I have to know how many I have on hand, to know how many I need to order next time. Or makes representations to creditors about the amount of inventory on hand, right? So if she got a loan outstanding and part of that loan is supported by the inventory she has on hand as collateral, then suddenly she is tracking her inventory and would be required to conform to inventory accounting. So the rules are really, really explicit about this. Like, you better not be counting your inventory at all. You better just be deducting it and pretending like it doesn't exist, right? Now, the problem is, to the extent inventory is a significant part of your business, no business should actually engage in that sort of operation, right? Because that's basically like saying, yeah, I don't keep track of my inventory, so it can just disappear and I won't know any better, right? So I buy 5, I use 1. What happened to the other 4? Oh, I guess they got used. No, like Jimmy, the assistant mechanic, stole all of them. Well, because you're not tracking inventory, you would never know that, right? And you legitimately aren't able to track inventory if you want to use this cash basis method. Okay, so LIFO and FIFO, I'm just not going to spend time on these. Boy, I certainly hope that you've learned LIFO and FIFO somewhere along the way as part of your intermediate accounting, or frankly, basic accounting. All right, let's do a few questions and then we'll finish out this section finally. Wow, we've done a good job. I appreciate you guys hanging in there. So DART is a C corporation, distributes software over the internet, and has had average revenues in excess of $40 million per year over the last 3 years. To purchase software, customers enter their credit card number to secure website, receive a password that allows the customer to immediately download the software. That sounds pretty familiar, right? That's kind of the way things work. As a result, DART does not record accounts receivable or inventory on its books. Which of the following statements is correct? So DART can use either the cash. You know what? Let's pause this one and I'll let you read through and then we'll come back. Okay. So the answer here is C. DART must use the accrual method of accounting. Why is that true, right? Why is he not eligible to use cash or any other method? Well, his revenues are in excess of $40 million per year for the past 3 years, and DART is a C corporation. So as a result, there is no situation in which they're eligible to use the cash method. Which of the following taxpayers may use the cash basis as this method of accounting for tax purposes? Partnership that's a tax shelter, a retail store with $2 million of inventory, average income of $35 million, an international accounting firm that's organized as a partnership, or an office cleaning business organized as a C Corp with average annual income of $35 million. Well, amazingly, the answer here is C, right? The big 4 accounting firms can all operate on a cash basis. So being a C Corp, takes you out unless your gross income is less than, currently 29 or 30 million, depending on the year. So 35 million gets rid of B and C. And if you are a tax shelter, you are cooked, right? You are not permitted to use the cash method. Technically, taxpayers must use the accrual method if they are C Corps, again, over that limit, partnerships that have a C Corp as a partner, trusts, and tax shelters. All right, even though I told you that I wasn't going to teach LIFO and FIFO, there are questions on the CPA exam. So let's get you ready to see what those feel like. Which of the following is true concerning the LIFO method as compared to the FIFO method in a period when prices are rising? This is a very common question. So hopefully you understand enough of your inventory accounting to answer it, but I'll pause. Okay. So the LIFO method of inventory is an assumption that the cost of goods sold is the cost of the most recently acquired units, right? Last in, first out. If LIFO is used, inventory must be valued at cost. Rising prices create higher cost of goods sold for recent purchases of inventory than for previous purchases. Gross income includes receipts reduced by cost of goods sold. Therefore, higher cost of goods sold using LIFO would reduce the profit margin and therefore reduce the current tax liability. So the answer is in fact D. D. Current tax liability is lower, cost of goods sold is higher under LIFO than it is under FIFO. All right, that takes us through the basics of kind of cash and accrual-based accounting method. There's one more little blurb. I kind of stuck it in. I said, hey, pull this amount from a chapter a long way from now. Again, pretty certain that Will covers this. So hopefully this is just review, but let's review the installment method. So Donald sold land to Joe for $100,000, and he collected $1,000 down and a 7% note for the balance payable in 3 installments of $33,000 of principal plus any interest that's payable over the next 3 years. Donald's basis in the land was $20,000. So what does this gain or loss look like? Well, here it is, right? Amount realized is $100,000. That's the $1,000 down plus the note that's worth $99,000. So there's the $100,000. Adjusted basis of 20, a realized gain of 80. If there were no such thing as the installment method, we'd have a recognized gain of 80. If Donald paid a 20% capital gains tax on that, he'd owe tax of $16,000. The problem is he's only been paid $1,000 of cash. And this is why we have the installment method, right? To help better match proceeds with the payment of the tax. So an installment sale applies where there's a sale of property where the seller receives the sale proceeds in more than one period. In this case, you'll recognize a portion of the gain on each installment payment received. You cannot use the installment method for inventory marketable securities or any depreciation recapture that results from the sale. Installment sale doesn't apply to losses, which is good. You want to just go ahead and recognize your losses, right? It must be elected out of if you don't want to use it. So this is not an election into the installment sale method. You must make the attempt to elect out of it if you don't want to use it. All right, so let's redo our sale and determine how we would treat this under the installment method. So again, same thing. Don sells the land to Joe for $100. The note plus the $33,000 of principal. So the first step we need to go through is determine the gross profit percentage, right? And we know the gross profit percentage because we calculated gross profit. That's 80,000 divided by the amount realized, or 100,000. So that's 80%. So what that means is 80 cents of every dollar that Donald receives is going to be treated as gain. All right, let's flush through that through. So in the year of sale, he collects $1,000. 800 of that is taxable gain. In year 1, he collects 33,000. 80% of that is 26,400. And same with years 2 and 3 till he collects all 100,000. And look, the total taxable gain is 80,000 because the installment sale method does not change the amount of the recognized gain. It only changes its timing. Now, the installment sale method can get slightly more complex when there's liability assumption or depreciation recapture. And what we're going to see is that we actually need to consider something we haven't really done before, which is the contract price. So we just glossed over it on the last one, and we said the amount realized is the amount we're going to use to calculate gross profit percentage. That's technically not true. We need to calculate the contract price. All right, so we should probably get rid of this big red thing that's in the middle here. And that's because it shouldn't have appeared until the end. So let's do that. Why not? Let's get that big red thing off. All right, wow, that looks better, huh? No big prohibited sign on there. Okay, so now we've got Don selling the land to Joe for $100,000, $1,000 down still, but now 3 payments of $28,000 of principal, because Joe is assuming a $15,000 mortgage on the land. So the total proceeds are still $100,000, right? It's the 1,000 plus the 3 times 28,000 plus 15,000 of mortgage gets us to the 100,000. Again, basis was 200,000. So if we determine the gross profit percentage under the old method, the one that we were used to, it would be 80 cents of gain on every dollar received. So when we do the math on that, however, you can see we're only getting 85,000 of cash. If I multiply that by 80%, oops, the recognized gain is only 68,000, and that is not good because the recognized gain is 80,000. So this is where the contract price comes into play. That's what makes this method wrongo. All right, instead, what we have to do is take the 80,000 of recognized gain and divide it by the contract price, not the amount realized. The contract price is the selling price less any assumption of debt. So in this case, it's 100,000 minus 15,000 or 85,000. So now the gross profit percentage isn't 80%, it's 94%. Okay, there's our recognized gain. Here's what our recognized gain looks like with a 94% gross profit percentage. And you can see that when we receive 85,000 in cash at 94%, we get the 80,000 that we expected. All right, cool. So Donald sold equipment this time to Joe. 100,000, 1,000 down, 7% note, 3 installments, 28, 15,000 mortgage assumed. In this case, not on the land, it would be a mortgage on the equipment. Donald's basis was 20,000. The original cost of this equipment was 50,000. I have unlimited Adobe stock downloads. Hooray! I don't even know what that means. Less 30,000 in depreciation. So that's where we got the basis. Okay, so what is the contract price, right? Well, the first thing we need to do is recalculate our gain. So because remember, we cannot use the installment method against recapture. So I'm presuming you've covered recapture. If you haven't, then this won't make any sense to you until such time as you have covered it. But I'm pretty sure it's getting covered this semester by Will. So the 80,000 gain gets reduced by the recaptured depreciation of 30,000. That leaves only 50,000 of gain to be recognized. 50,000 divided by the contract price is 59%. And guess what's going to happen? We're going to recognize 50,000 of gain over each of the payments. That total 85,000, but there's the 50,000 gain that we needed to recognize. That recaptured gain gets recognized in the year of sale. So on top of the gain of 587, we would also recognize the recaptured gain of 30. So 3587 would be the year 0 or year of sale recognized gain. Aviary sold a building for 600,000. Aviary received a down payment of 120 as well as annual principal payments of 120 for each of the subsequent 4 years. Aviary purchased the building for 500,000, claimed depreciation of 80. What amount of gain should Aviary report in the year of sale using the installment method? And I definitely think we ought to pause so that you can do this. This is a CPA exam question. So let's see if you can solve it. Okay. Well, let's see if we can march through this. The first thing we always do is calculate the realized gain. So what is the realized gain? Well, they sold it for 600,000. So 600,000 is the amount realized. What is the adjusted basis? Well, they purchased the building for 500, claimed depreciation of 80, so the adjusted basis is 420. That means the realized gain is 180,000. Okay, now there's no liability associated with this. So, but there is some recapture, perhaps. But remember, this is a building. This is a building. And again, if you haven't had recapture, you're not going to get it. But a building is subject to 1250. And 1250 is only accelerated depreciation, of which there hasn't been any since 1981. So as a result, there is no depreciation to be recaptured. Okay, so now that we know that, we've got a gain of 600 minus 420, that's 180,000, divided by the $600,000 selling price, which also equals our contract price in this case. And so that means 180 divided by 600,000 is 30%, which means that for every dollar we receive, we're going to take 30% of that and treat it as gain. So it looks like we're going to receive 120,000 in the first year, the year of sale. So 120,000 times 30% is 36,000. So the gain we would recognize in the year of sale is 36,000. Okay, in year one, a taxpayer sold real property for 200,000, received 100,000 at closing, 100,000 plus accrued interest in the next year. Buyer also assumed a $50,000 mortgage. The adjusted basis was 75,000, and the taxpayer incurred 10,000 of selling expenses. If the transaction qualifies for installment sale treatment, comma, what would the gross profit be? What would the gross profit be on the installment sale? Not the profit in the year of sale, but what is the gross profit? All right, so this is actually a little bit easier than it looks. Let's see if we can figure this out. Okay, so the contract price, right, the amount realized is 200,000 plus 50,000 mortgage on the property. So assumption of liability is part of amount realized. So that means it's sold for 250. The basis is 75,000 plus the 10,000 of selling expenses, or 85,000. And 250 minus 85 is 165,000. So the gross profit is 165,000. Okay, this is the last question in this video, and this video is almost gone an hour, and this is in fact a tough one, because what I'm going to ask you guys to do is go out and use Form 6252 to actually calculate the installment sale gain. I posted the form in week 2 in class exercises, so I'm going to encourage you to do that. I'm going to pause the video. When we come back, I'm going to walk through the form so you can see the calculation. So take a moment, read this, then see if you can work out the form by yourselves. All right, here we are at the 6252. I've kind of pasted the data in here on the top so that we can look at it if we want to. I filled out this top part, but presumably that's not where the bread's getting buttered. So what is the selling price, right? It sells the property for 120, 8,000 in cash, assumption of a 12,000 mortgage, and a $100,000 note. So there's the 120,000. So the selling price is 120,000. What mortgages were assumed? Well, there was a $12,000 mortgage assumption, so 12,000. Subtract 12 from line 6 from line 5, 108. What do you think 108 is? That's the contract price, right? So what is the cost of the property sold? It was 80,000, right? It says so, 80,000. What was the depreciation allowed or allowable? It was 26,000, so that gives us our adjusted basis of 54. There's some stuff down here on the bottom for selling expenses that we get to ignore, and so 54,000, the 120 minus the 54, there's our gain of 66,000. Okay, so our gross profit is 66,000. We're going to end up dividing that by line 18, the contract price. What is the contract price? There it is, 108. So that's 0.61111, right? It says divide 16 by 18, 16 by 18. What if this is the amount of year of sale? Enter the amount from line 17. This is the year of sale, but I guess there was no cash collected. Is that the case? Let's go take a peek. Yeah, I don't know what that is, but we're good because the payments received during this year are 8,000, right? They paid us 8,000 down, correct? 8,000 down, the rest of it is a note payable in future years. So I take the 8,000 and multiply by the gross profit percentage. I get my installment sale income of 48.89. And that's it. See, it's not too bad. I think the form actually does a really good job of walking a taxpayer through how to calculate the installment sale method. Cool. And I'm happy to report that at the 1 hour mark, we are at the end of this video.